Alan Greenspan is dead at 100 years old, and his death comes at a fascinating time for the Federal Reserve today. Because while America is looking back at one of the most influential Fed chairs in history, businesses, investors, government contractors, and federal agents are trying to figure out what comes next under Federal Reserve Chair Kevin Warsh. And that matters because the Federal Reserve doesn't just influence interest rates, it influences business lending, government spending, and the federal budget. Think about this. It influences how government contractors and businesses grow based on how expensive money is. In other words, if you've ever wondered why a company delays hiring, why borrowing money suddenly gets painful, or why federal government agencies seem to have less room in their budgets, the answer often starts with the same institution, the Federal Reserve. For nearly 20 years, Alan Greenspan helped shape an America where money felt relatively cheap and credit was easy to find. Kevin Warsh, on the other hand, appears to be asking a very different question. What if money isn't supposed to be cheap? And if that becomes the Federal Reserve's philosophy, the consequences won't stop on Wall Street. They're going to show up in Washington budgets. They're going to show up in business loans. And they'll show up in government contracting. Because the Fed doesn't decide who wins federal contracts. It does decide how expensive winning them becomes. Now, let's be fair to Greenspan. When he took over the Federal Reserve in 1987, the Cold War was still going on. The internet barely existed, and most Americans had never heard the phrase artificial intelligence, unless they were watching a science fiction movie. By the time Greenspan left, America had experienced a stock market crash, the dot-com boom and bubble, a recession, and the aftermath of 9/11. Through most of that period, Greenspan became known as a guy who could calm markets. Investors trusted him. Businesses trusted him. Politicians trusted him, sometimes a little bit too much based on everything. But over time, something happened. America got used to cheap money because businesses borrowed, investors borrowed, home buyers borrowed, the federal government borrowed. I mean, everybody borrowed at this point in time if you lived through that part of the history. But this is the key. Everyone started acting like low-cost credit was just a permanent feature of the economy, kind of like electricity or Wi-Fi, or honestly complaining about the terrible airline seating prices we get today. Then reality showed up. Inflation. Suddenly, all that cheap money didn't look so cheap anymore. And that's where today's story really begins. Because Kevin Warsh isn't inheriting Greenspan's economy. He's inheriting an economy that's trying to break a decade-long addiction to cheap money. Think about it this way. Imagine your household credit card bill doubles overnight. You probably start making different decisions. Maybe you postpone a vacation, postpone a major purchase. Maybe you stop pretending that online shopping is a personality trait. The federal government faces a similar problem, except instead of carrying thousands of dollars in debt, it carries trillions. It can also just print money as well. You and I can't. When interest rates stay elevated, interest payments on that debt become more expensive. And every dollar spent paying interest is a dollar that can't be spent somewhere else. Infrastructure, defense, research, on and on and on. Now, that doesn't mean agencies are going to stop buying things all of a sudden. The Department of Defense still needs equipment. Federal agencies still need cybersecurity. The government still needs contractors. But higher borrowing costs force harder choices. And that's where business owners and contractors need to pay attention. Because most contractors obsess over agency budgets. They watch appropriations. They watch continuing resolutions. They look at their procurement forecasts. All of these are important. But many completely ignore the cost of money. That's a mistake. Winning a contract is one thing. Financing the contract is another. Think about it. You get a major federal award. Awesome. Congratulations. Now you need people. You need equipment. You need software. You need subcontractors. And you need all of these things before the government pays you a dime. Anyone who has worked in federal government contracting knows the government can move at many speeds. Fast, slow, it's still being reviewed. And let's be honest, usually it's slow. That gap between doing the work and getting paid has to be financed. That float used to be cheap. It isn't anymore. And because when money is cheap, it's manageable. When it's expensive, having that cash on hand becomes a huge competitive advantage. The companies with strong balance sheets are going to get stronger. The companies with weak cash flow are going to feel the pressure and get weaker. And suddenly the question just isn't who can win the work. It's who can afford to perform it. And by the way, you're seeing this as more institutions and government organizations across the board start really analyzing your financial stability as a company. And that's why this Greenspan versus Warsh comparison actually matters. Not because one man is good and the other man's bad. Not because one is right and the other one is wrong. But because they represent two very different views of money. Greenspan became associated with an era where markets often expected support when things went wrong. Warsh appears to be signaling something different: discipline, credibility, and the possibility that higher borrowing costs may be around longer than people hope. For business owners, that means growth may become more expensive and you may need to pull back a little bit. For investors, it means risk gets repriced. For government contractors, it means cash flow matters more than ever. And for Washington, it means every budget conversation becomes a little bit more difficult. Which brings us back to Greenspan. His death isn't just the end of a remarkable life. It may symbolize the end of an era of economics, an era where Americans assumed money would remain cheap, borrowing would remain easy, and the Federal Reserve would always be there to cushion the landing. Kevin Warsh may be rewriting the next chapter. And if he is, the biggest changes won't happen on Wall Street. They're going to happen in boardrooms, at small businesses, inside federal agencies, and in the offices of government contractors trying to figure out whether the next opportunity is worth pursuing. Because the Federal Reserve doesn't decide who wins contracts, but it does absolutely decide how expensive winning them becomes. Thanks for watching. If this helped you any way, shape, or form, please hit like, please subscribe. It really helps this channel. If you have any questions, put them down below in the comments. We try to answer every single question as they come in. As always, thanks for watching.